The L&G Global Quality Dividends ETF is a relatively new fund, but it's already a massive hit among dividend investors. It offers incredible diversification, holds exclusively high-quality dividend companies, and pays out every single month. We've actually talked about this specific ETF a few times before on this channel, and since I'm a huge fan of it myself, I'm currently building up my own position. Naturally, I started wondering, how much money do I actually need to invest to hit a specific monthly income, say 100 or 500 euros? To find out, I crunched the numbers for two different scenarios, a conservative one and a more optimistic one. Because this ETF is brand new and doesn't have a long track record yet, I had to make a few smart assumptions regarding its dividend yield and growth rate. In this video, I'm going to share those results with you, so make sure to watch until the end to see how the math plays out. But as always, this is not financial advice, just my own opinions and experiences. All right, let's start with the first scenario. For this one, we're keeping our assumptions pretty conservative. Here are the numbers we're working with. First, a dividend yield of 3.5%. Why this specific number? According to the official ETF fact sheet, the underlying index yields about 3.7% per year, but to play it safe, we'll round it down to 3.5%. Next, we assume a dividend growth rate of 5%. In my opinion, an ETF that focuses strictly on dividend growers should deliver at least 5% dividend growth per year. We also need to estimate the annual price growth, which is crucial for our dividend calculator. Over the last 5 years, the index delivered a total return of around 10% per year. If we subtract the dividend, we get a price growth of 6.5%. But again, to be safe, we will assume 6%. Now, let's look at what happens if we invest 10,000, 50,000, and 100,000 euros, assuming we don't reinvest the dividends at first. Let's see what the cash flow looks like. I plugged these numbers into a dividend calculator. And here are the results. These are the monthly payouts you would receive right from the start. And these are the payouts you would get down the road, thanks to that 5% annual dividend growth. This already looks pretty good, but let's see what happens when we turn on dividend reinvestment. In yellow, you can see the monthly payouts if all dividends are reinvested. One thing is obvious, especially in the long run, reinvesting your dividends gives your cash flow a massive boost. All right, that was scenario number 1. Now, let's take a look at the optimistic scenario. For this one, we're going to adjust our numbers a bit. First, a dividend yield of 3.9%. Why exactly this number? Well, if we look at the data, the ETF has paid out dividends 4 times so far, at exactly 3 cents per month each time. If that trend continues, we're looking at a 3.9% yield, which is actually a bit higher than what the official documents suggest. By the way, I'm really impressed by how stable these payouts have been so far. I really hope it stays this way. Now, this is where it gets interesting. Next, we assume a dividend growth rate of 7%. In scenario 1, we used 5%, but I think this ETF has more potential, so I'm bumping it up to 7%. Let me briefly explain why I think 7% is realistic. That is roughly what a top-tier dividend growth ETF can achieve. We can see this, for example, with the Fidelity Global Quality Income ETF, which uses similar quality filters. It delivered a 7% dividend growth rate for a long time, though it has struggled a bit recently. Unfortunately, we don't have a dividend history for this L&G ETF yet. Even the underlying index doesn't give us direct data on dividend growth. So, out of curiosity, I asked a few different AI models what kind of dividend growth they expect from this ETF. Now, I don't trust AI blindly, but I still wanted to see what kind of numbers they would come up with. And here are the answers I got. The estimates range from 5% all the way up to 10%, which is even higher than my optimistic 7% guess. However, I want to stick with 7% for our calculations, because I think 7% is already very solid, and anything higher might be unrealistic. As for the expected price growth, we will keep it at 6% per year. When you add the dividend to that, we're looking at a total return of almost 10% per year, which is admittedly very strong. Once again, we will look at investments of 10,000, 50,000, and 100,000 euros, starting with the assumption that dividends are not reinvested. This gives us the following monthly cash flow. As you can see, that 7% dividend growth really starts to compound beautifully. With a 7% annual growth rate, your cash flow doubles roughly every 10 years, which I think is absolutely incredible. Finally, let's look at what happens if we reinvest all of our dividends from the start. With our assumptions of an almost 4% yield and 7% dividend growth, the difference between spending your dividends and reinvesting them becomes like night and day. So much for the calculations of our potential cash flow. If you ask me whether Scenario 1 or Scenario 2 is more realistic, I'd say the truth lies somewhere in the middle, which would still be incredibly solid. Even if we end up with a 3.6% dividend yield and 6% dividend growth, that's still much better than the Holy Grail, the Vanguard All-World Dividend ETF. That's why I'm very bullish on this LNG ETF, and I'll keep building my position until it makes up 20%, or maybe even 30% of my portfolio. At the end of the day, these calculations prove one thing above all else. The secret to a massive cash flow is patience and reinvesting. Once you get that snowball rolling, you'll be rewarded with a seriously solid passive income down the road. What percentage of your portfolio does this ETF make up so far? Let me know in the comments below. Don't forget to like and subscribe if you want more real talk about dividend investing. See you in the next video. Take care and ciao.